Hello, everyone, and thank you to SCB 10X for organizing this panel today. My name is Samar, and I'm the head of Talos here in Asia. Talos is the largest provider of digital asset trading technology for institutional firms on the buy side and sell side. And we're here today to talk about crypto trading trends in these challenging market conditions. And who better to speak about this than the founder of a premier crypto investment firm and the CEO of a top institutional crypto liquidity provider. I have here with me Dariussitzl, founder and CIO of Qcb, and Phil Gillespie, the group CEO of B2C2. Thank you both for being here today. So maybe can you please introduce your firms to the audience? Why don't we start with you, Darius?
Thank you. Thanks, Samar, and good to be here. Qcb Capital is a full suite cryptocurrency trading company. We trade across the board. We trade spot, derivatives, especially options, and in particular in options, we are primary market makers. So we make markets on exchanges, OTC, as well as DeFi. We are top three for volumes in all three there. And we also do quite a bit of investments, VC type, private equity investments in the space.
Thanks, Darius. I'll turn it over to you, Phil.
Sure, thank you very much. So B2C2 is primarily a liquidity provider in the crypto space and one of the largest in the OTC, mainly institutional liquidity provision. And what we're really trying to do is provide the platform and the access for institutional accounts to be able to access crypto in a safe and efficient way. We've been doing this since back in 2017, 2016, and we have a pretty large presence in all regions around the world.
Thank you. So let's get into it. Phil, these are challenging market times. Can you share what trends you're seeing in crypto trading in this current bear market, maybe with regard to volumes, coins, buy side versus sell side, whatever you can share?
Sure. So yeah, it's kind of interesting because I think both Darius and I have lived through several crypto winters, and I can automatically say there's a few things that's different about this particular 2022 so far. For one, we're still seeing a lot of inbounds for clients wanting to onboard, which is very different. In 2018, I remember it was dead, and it was really, really dead. The volume, the interest, nobody was really coming through, asking for a new onboarding. And now the queue has only accelerated, despite everything that's happened in May with Terra Luna crash, and then in June with all the credit contagion. The demand is still very much there. So that's number one. Number two is what I think is very interesting. I'd love to hear what Darius thinks about this as well. But there was a lot of issue with DeFi and Terra Luna and so on in May. And what we're seeing now, though, is that there's still thirst for yield. And one of the stuff that we're being asked to provide is more like structured products in regulated jurisdiction. So regulated yield enhancement products, call it CFI if you will, or whatever you want to call it. But it's basically how can we use derivatives, how can we use options, provide enhanced yields to downstream customers. So I think that's an interesting trend. The demand is still there, it's just in a slightly different form. And it's more coming from, hey, how can we get this access in a regulated and safe way? And the clients that are asking this are usually the larger, the larger institutions. They tend to be more TradFi oriented that's coming into crypto.
Thanks for sharing, Phil. Darius, what do you have to say about that? Do you agree?
No, yeah, I just to echo what Phil has said, I think the key difference is that in the last bear markets that we've had, the crypto players, everybody actually at the back of their minds were thinking, is this going to survive? Is this industry going to survive? There was an existential question. When Bitcoin is at 3K and from 20K to 3K or stuck at below that, you actually ask that question. But I think the key difference in this bear market is that I don't think we ever asked that question. For us, it's just credit crisis, it's a deleveraging cycle, but there was never this question of whether, you know, we're going to survive. And infrastructure wise, I think, you know, it's very, very different as well. Previous bear markets, you saw a breakdown in trading of order book infrastructure, settlements at issues. You know, there were these blackouts, so to speak, right? In this bear market, and even when the market was in shock, trading infrastructure performed well. Liquidity was good. You could always get in and out, no problem, even though the prices were volatile. Settlement was fine. Derivatives were fine as well. So it really was a specific credit problem. Guys who don't have any credit exposure, no impact. In fact, you know, business is good. So I think, you know, it's a very, very different, we're in a very, very different environment right now. The market has matured to a stage where, you know, institutional guys can come in, and they are coming in, like Phil is saying, right? And thirst for yield, for sure. I mean, the irony is that even though the yield on the credit side is broken, and you're seeing this, you know, in DeFi as well. You know, you no longer get that 20% yield on UST. But you know, I think ironically, because of the bear market, the vols are actually trading much higher. We're trading at triple handle, you know, over 100% vol in Ether and other coins, and I think, you know, that's actually creating a lot of a good source for yield and structured products. And like Phil said as well, you know, I think in previous times when in the bear market, you know, the TradFi perspective was, oh yeah, you know, I told you guys this industry is gonna die. But now the TradFi guys are like, okay, you know, the prices have dropped. I think it's a good time for us to enter. So I think there's a very, very fundamentally different change in the way people are viewing the space.
Thank you.
Yeah, just to add to that, you know, it's really interesting because you know, to Darius's point, I remember in 2018, you know, a lot of high-profile, senior executives, we won't say who, were coming on and saying, "Oh, this is a, you know, magical coin. This is not real." Now the same companies are coming and saying, "Hey, you know, we'd like to talk about getting NDF liquidity. What do you think about da da da?" So very different, right? It's definitely, they're looking at this as an opportunity to come in, and you just see the larger players much more, you know, much more kind of actively participating now.
Exactly. And I think, right, you know, in the midst of this bear market, you have the Bank of International Settlements coming up to say that, you know, they're allowing, encouraging banks to keep 1% of their reserves in Bitcoin. I think that's extremely significant, right? You know, in the midst of 2018, you know, when I went to see Phil in Japan, it was both our teams were what 10 people, and you know, we were hanging out in co-working spaces. Now it's different, right? You know, now we have nice offices, we have we look very institutional as well. So I think, you know, I think the banks and the finance industry as a whole is starting to see that Bitcoin, at least, you know, it's a store of value, and recognize it as a legitimate asset.
I appreciate that. And a lot of what you say also resonates on our side too. We see a lot of institutional players come in, and they recognize that the market is becoming more professional and more stable. Darius, compared to like a bull market though, you know, as an institutional investor, are there still trading strategies that firms can deploy today to generate decent returns in this type of market? I know you mentioned a couple things already.
Yeah, so I mean, we are options focused, so you know, we tend to look a lot at that. And you know, our fear actually, in, you know, late last year and early this year, our fear is that vols hit the way of traditional market vols like FX or equities, right? You know, we started to see Bitcoin going towards the 30%, 40% handle. That was a bigger fear for us because you know, most people trade crypto vols because of the high vol handle. So when vols go back to 150%, it's good. It's good for all option market makers, right? You know, there's a lot more fat, there's a lot more juice there. You know, we actually prefer the implieds to be higher. So you know, there's a lot more trading strategies that we can be deployed. On the investment side, I think you know, the the valuations are a lot more sane right now as well. You know, I think late last year, earlier this year, you know, when you start seeing token projects that come up with a deck and then raising at $1 billion, that's just not healthy, right? Especially, you know, the industry was going towards this whole idea of non-utility governance tokens. I mean, they're literally telling you that, you know, my tokens are of technically no fundamental value, but, you know, please invest in them. You know, the speculators will take them up to high level. So I think, you know, in essence, I think, you know, it was good for us to get rid of that whole froth, and back to where you know, focus on cash flows, focus on value accrual to tokens, focus on building the tech, and, you know, trading wise, I think, you know, focusing on liquidity and you know, real value in derivatives as well. A lot of the credit, I think, was mispriced. You know, crypto is a space where credit is very immature, and I think players like B2C2 ourselves are working towards building a better credit market. I mean, just to give you a sense of how immature the credit section is, right? I mean, credit ratings are essentially done on Twitter. No, there is no proper credit rating in you know, a segment. You know, Three Arrows got their AAA rating from being Twitter experts. And you know, there isn't any objective reference rate in the space. You know, every exchange has their own reference rate, every OTC has their own reference rate, and then you throw in DeFi and there's a whole crazy range of rates as well. In fact, a lot of the market makers imply forward rates from the vol market, which is a bit of an inverse method of doing it. So, you know, I think it's very immature. I think you know, a lot of us are working towards building a better, more mature one, and I think we can build the credit market from there. But credit aside, I think everything is working well. Liquidity is good, better than ever, and you know, a lot more interest and participation from good players.
Darius, thanks for that. We're going to get to risk and credit in a little bit later down. But Philip, I also wanted to ask you, I'm sure you have a ton of institutional clients who are still employing profitable trading strategies. Anything you want to share there from your side?
Yeah, I think Darius, like Darius mentioned, I think right now, you know, we started out first in spot liquidity and then started going into CFDs. Now, really, a lot of the demand that we're hearing from really large guys are around like NDFs. You know, they have issues touching the physical coins, so they want to get exposure through NDFs. And in terms of yields, just given where vol's pricing, you know, a lot of guys want to sell vol. So we have our like DCD like types of products where, you know, you just lend us the underlying fully collateralized and it will sell options to generate these yields. So these are really the kind of the direction that we're seeing. Outside of that, you know, I think before there was a lot of guys trading the basis and doing that kind of stuff. But I think exchange Rs, basis trading, all of those opportunities have gone lower, and now we're seeing more interest in products like, you know, wanting to trade NDFs, wanting more access on, you know, options on an OTC basis. So I think Darius and I are seeing the exact same thing on our both sides.
Thank you for sharing. And Phil, as a liquidity provider, you know, what do you suggest to your clients and the audience on how to access liquidity when the market is drying up, or if it is at all for certain coins?
Phil froze up.
We may have lost Phil, but we'll continue and wait for him to come back on. So Darius, let's talk about risk for a second, right? Because we're touching on it, but it's obviously we need to get into the detail. So we've seen what happens when firms aren't managing their risk responsibly.
In what sense?
Yeah. Hi, Phil. So we had lost you for a second there. So we'll come back to you in just a second. Risk responsibly. So what are some of the unique risks involved when you are crypto trading? Let's get into them. All of them, and how do we mitigate these in the next growth cycle?
Yeah, I think, you know, that's a very tricky question to answer. I mean, because it's I guess it's not anything new or not any rocket science, right? I think one problem with crypto space is that you don't have the same kind of infrastructure yet in terms of settlement and maybe like prime brokerage that you have in traditional markets, right? A lot of the trading relationships are very bilateral. So like, you know, when I trade with Phil, we manage our risk bilaterally. If we don't net it across we don't net it across various counterparties. There's a bit of lack of transparency. I mean, if I trade with Phil, he doesn't know what I'm trading with Genesis, he doesn't know what kind of line I have with other counterparties, right? So there's a bit of lack of transparency there. I'm not able to novate trades between counterparties as well. And all you see is whatever your counterparty tells you. So there's a bit of I think some work needs to be done on that front. And I think also, leverage wise, you can take a lot of leverage in crypto. Like I said, a lot of the credibility is established on Twitter rather than more sensible methods of due diligence. So I think quite a bit of work needs to be done there. But with that said, you can avoid going crazy in crypto. I mean, just making sure that you manage your collateral, don't offer too much leverage, don't take too much leverage. I think the usual risk management methods and techniques apply here as well. And you can see that the guys who have done that have been able to avoid a lot of the potholes. We might feel like idiots as the bull market goes because we're not making as much money, or it doesn't seem to be making as much money as the rest. But when shit hits the fan, the risk management counts. So I think that's what's important.
Yeah, well said, Philip. Maybe you want to opine as well of what you're seeing in terms of how you manage risk or how your customers manage risk.
Yeah, I have to agree. I mean, the hardest, especially when there's credit contagion like this, is how do you assess and how do you model credit risk? And I think Darius really, nailed it on the head when he said, like firms like us, we need to be conservative sometimes, with the limits, with everything. And it hurts us in the bull market. But really, when you see these downturns, you see it really works out because, really in this kind of market, it's that when there's no PB and there's no real credit intermediaries, and we're having all these bilateral relationships, we need to be very careful about the credit lines that we're extending, and how you assess that risk. It's you have a lot of concentrated risk as well, and I think that's what you're seeing right now. When we had all this issue with 3 Arrows and everything else, it wasn't just one company; it's literally tons of companies. The issues that we have is really it's hard to see further beyond just the financial statements, so we just have to be very careful. We have to be, we have to always play on the conservative side. And firms like QCP with Darius, we've known them for a very long time. We know how they settle, we know how they trade. So these kind of, the partnership and trust starts to build so that you can actually, how they're operating a business. You're comfortable with the bilateral relationship, but it's a very tricky thing for us to manage. And I think all of this will start to change because, like for ourselves, now we're owned by a public company. We're owned by SPI Holdings. We have parental guarantees. We have all of these other, extension of credits that allows for larger players to come in and face us directly. And you're probably going to see more and more of this, right? Consolidation, and you're going to see more of these kind of acquisition and M&A going through with the right counterparts. So.
No, the irony of a firm that has good risk measures, when you end up being frustrated with them, you bump heads. So I've had more than a few conversations with Phil. I'm like, your limits are too tight, give me more limits kind of thing. And so the irony is that when you have these kind of frustrating conversations, your counterparty is safe.
Yeah, it's love-hate, but then you have much more trust in the system. Yeah, that sounds more responsible. So Phil, let's get back to the original question I had asked you before we had a minor tech hiccup. So as a liquidity provider, what do you recommend to your clients or the audience on how to access liquidity when the market is drying up? Is there more that clients can do to aggregate liquidity, or is it across certain coins only that challenges are being seen?
Well, I'm going to be talking my own book here, but I really think, especially when you start seeing this kind of dislocation in the market, you really have to go to your trusted liquidity, source. And I would think that OTC is definitely the way to go, because I think, and there's a lot of views here, but credit risk can extend to exchanges as well. It can obviously happen in OTC space as well. But I think in terms of pure liquidity access, I really think the exchange is going to consolidate. The share of OTC and kind of the consistency of the OTC pricing of liquidity provision is going to far outweigh other conveniences that exchanges might offer. And so I would think that, especially in time of need, and we've actually done studies around this, and we share every now and then to, potential kind of partners, strategic partners, and even, investors who might be interested in, talking to us. We have our spreads versus all the exchange spreads in time of need. So we had the March 2020 COVID crash. Last May, we had a sharp drop. And this year, again, in June, we had the sharp drop. And every time what we do is we overlay our pricing with the exchange liquidity pricing. And it's very clear that if you want consistent liquidity, if you don't want slippage, if you want to be able to execute, OTC is definitely the way when you have massive volatility in the market. But, again, like Darius and I keep saying, it's hard to then assess the credit risk and stuff. And that's why you need to go to the trusted partners where there is some kind of a guarantee or some kind of other protection that makes you more comfortable in executing all the trades with that OTC provider.
But Philip, I mean, as well as that, it's the convenience of that institutions can work on with credit limits rather than pre-fund, right? That's a major point.
Yeah.
So Darius, just turning it over to you, how do you decide, which LPs to work with and why? Just curious.
No, I think that again, that's a very tricky question to answer because again, there's no credit rating or anything. I think we struggle with this in terms of who for counterparties we want to get limits and also who to give limits to. One method, of course, is like Phil said, knowing each other for many years and having had a relationship already for many years, that counts a lot. But with new counterparties, we are very careful, and I think sometimes overly careful because again, you don't know what's on the books. I mean, with the Three Arrows guys, everyone thought that their books were flush with cash, but it ends up, the leverage is tremendous and it's shocking size as well. So and the people who the guys who lent Three Arrows money and extended credit limits to them are not stupid people either, right? If you look at all the affidavits in the credit case, they presented official documents with NAV statements and all, and it all turned out to be false. So how do you assess that, right? I think a lot of it is sort of getting to know the opposite team as well, getting to know the founders and understanding what their business is. If some things don't make sense, sometimes if some things are too good to be true, sometimes they really are too good to be true. So I think some sanity is required. And again, it's not too far a departure from the usual due diligence that we do in traditional finance. I think, it's just understanding the business and being a bit more careful on that front.
Yeah, thanks for sharing. Speaking of traditional finance, and I'm curious to hear from both of you, are you getting a sense that more and more institutional investors, will be coming in to trade crypto, or have they been frightened off after this current market drop? Maybe I'll go with Phil first.
Yeah, so I think there's two sides here. I mentioned earlier about a lot of big TradFi names coming and saying, hey, and I think you see some headlines as well saying, so-and-so investment bank starting NDS, so-and-so investment bank starting derivatives trading. So definitely the angle of attack from a lot of these larger TradFi names within the derivative space, it's just so much easier. The regulation, you don't have to touch with the underlying physical coins. You just want the exposure. And remember, they have their end clients who are requesting this, right? So that demand is there, and you can easily see it just by Googling these larger banks coming into the space through derivatives. I think, and I think another aspect though is, and I think Darius might be more in line with this, is on the private equity VC side, I think they're actually taking a slightly step back, right? It's a lot of them got burned by pouring money into the space, into a lot of projects and a lot of companies, and now I think they're kind of taking a step back and reassessing. I think everybody agrees it's a great opportunity to come in, and when things are distressed, you want to look for that value. But at the same time, just given what's happened in the last 2 years and all this crazy valuation and the crazy amount of money that's been poured into a lot of projects and companies that might have failed, these guys are slightly bit more conservative. So you have the more proactive guys who are coming into the space, and the banks, the hedge funds, all these other kind of counterparts. And then the private equity investment money probably is taking a slight step back as they assess the credit contagion and everything else.
Darius,
Oh, yeah. I completely agree. I completely agree with Phil. I think the way that the institutional traditional finance guys come in is through derivatives, right? So I think earlier last year, QCP and B2C2, we did one of the first NDF trades because we know that a lot of the NC guys don't want to manage a spot. They don't want to manage physical spot, right? It's the same way that they prefer to trade paper oil contracts rather than handling the barrels physically. Very similar. They just want to trade, they want to cash settle, and options and structured products is a very easy way for them to come in because essentially it's the same thing that they're already trading with just a different underlying and maybe high volatility. So I think that's the big theme that we're seeing. So options, in the last 4 or 5 years have taken quite a backseat to DeFi, NFTs, and all of that. But I think as NC guys come in, I think structured products, options, I think CFDs, derivatives in general, might be the big theme for the next couple of years, where infrastructure is being built, settlement infrastructure is being built, liquidity is important. I think that could be a very big theme coming up as the funds and traditional finance guys come in. And on the private market side, I think the immediate guys that have suddenly poured into the space are the lawyers and liquidators. Suddenly, I'm getting a lot of calls from them saying that, you need to introduce me to all the crypto guys because, now there's a lot of business here. So that's the that's the most immediate interest. But Phil's right as well, right? I think the VC guys and PE guys who had invested in the space earlier, they're taking a step back. But at the same time, they I think they are definitely eyeing the space. I think I saw a very interesting stat recently that this was shown to me by the MAS, right? That if you look at tech patent requests and patent approvals in the tech space and in general, blockchain patents have 5 times more volume than the second or next, which is like AI or machine learning, or autonomous technology. Blockchain has 5 times more than any of them, right? The last time we saw this was in the 2000s with the internet. So I think there's this pervading view in the VC space that we might not exactly see the current companies, becoming the next Amazons or the next Googles, but it's there, right? In the next 5 to 10 years, the same way in the 2000s where the pet.com didn't make it, but every company now to some extent or in some way or fashion is an internet company. In 5 to 10 years time, every company in some way or other is going to be a blockchain company, whether it be a small segment of payments or whether it be a small segment of rewards or loyalty or settlement or some infrastructure. Every company is going to be a blockchain company. So I think that the prevailing sentiment is that that's going to happen the same way it did in the internet, and that they need to get involved. So while some of them have been burnt, I think some of them are seeing a lot of value in the space as well because valuations have come back down to sanity. So I think it's good and bad, I think, but to me, it's an overall optimistic kind of view of the space.
Oh, that's good. Thanks for sharing that, Darius. And, something that we often hear is that, longer term players who have seen multiple cycles often believe that in market downturns, there's no need to panic. It's actually a really good time to build so that, you're able to offer even better products in the next iteration and be ready for the next bull cycle. So, speaking of that, if you agree with that, I'm just curious to know, like, for your firms, B2C2 and QCP, for the next, 6 to 12 months, what are some of the things that you're focused on building or shoring up in terms of your tech or your product offering? Curious to know. And I guess we'll start with you, Phil.
Sure. So it's not that we kept this a top secret, but maybe it's a good opportunity to mention this. We're actually building one of the first private order books. So this is interesting, right? One of the things about OTC that's different from exchange is exchange, you're able to place orders, you're able to do all these things. And what we're looking to do is, when you look at exchange execution, there's a lot of market impact as well. So we actually are building private order books that the clients can actually access. And there's a lot of benefits here. You can actually execute on a stealth basis. There's no reason to show your hand to the entire world. If you have to buy $100 million worth of Bitcoin or more, and when the institutional guys come in, that's the kind of size that we're talking about. They don't want to do it in exchange because of the market impact. They don't want to necessarily pay the spreads as well. So we really need to be able to develop private order book functionality that allows for orders to be worked and executed. So this is something that we will be looking to release later this year, and I think this is going to be very, very important. And again, goes to show why OTC is going to just continue to grow its presence, I think, because no pre-funding, like you mentioned earlier, trading on credit and all these things, and then having access to all these functionality is just a win all around.
Phil, are you talking about dark pools?
No, I'm not. This is more just pure business offers that you're able to place that you can actually execute based on our liquidity and our pricing. So it starts out there, and then you start building algos and so on top. It's what a lot of the banks offer on FX as well for their order book capability. So that's one. And in terms of derivatives, we're definitely working more and more on structured products because that's just what a lot of clients are requesting. So that's another one that we'll continue to do. And thirdly, really, again, I think that Darius and I see really eye to eye in this is that, I don't know how to say this when there's blood on the street, right? There's a lot of opportunity. And another thing that we want to look at is really opportunities, strategic opportunities, potentially investing and potentially looking to partner up with really good firms that might be in the need of capital, that might be in need for some assistance. And I think this is exactly the kind of market that you want to go out and you want to start looking for those opportunities. So those three things, building up these new functionalities around order books, expanding the derivatives product offering, and finally looking for investment opportunities should be on the radar for anybody in this space.
Thank you for sharing that, Philip. Darius, how about you guys?
Yeah, very, very similar flavor to what Phil has said, and we would definitely be very keen to use that product that Phil was talking about, for B2. But very similar flavor for us. I think building up for us is going to be primary liquidity provision for options on exchanges, as well as DeFi. And I think a lot of that is going to be a tech play as well. Getting your systems faster, sharper. That's something that we haven't. We are one of the few companies that don't have a 200 strong dev team. Right, our dev team is a lot smaller and based in Singapore, but we're building that up as well. So getting our tech up to speed is one very important one. We are also creating, so right now we have a spot desk, we have a sort of prop balance sheet desk, as well as a very big options desk. We are building our own, or rather trying to build up our quant capabilities, systematic trading capabilities. That's something we've done as well. We've hired some senior guys from TradFi who are experts in these fields, and and to improve that operation for us. And also like Phil mentioned, we are focused on investment opportunities in the space. There are companies that are going for 90% below, 80-90% below last executed prices in the market, and these pieces are core infrastructure in the space. So I mean, for us, Deribit is a very big core infrastructure piece for us as option market makers, and that's something that we are big shareholders there, and we're looking to support them and help them expand their effort. Other pieces as well in terms of settlement, option settlement, and trade in general, trade settlement. I think there are a lot of valuable pieces in the space that are now going at discount. And to us, I think we did a sort of review of our own investments from the past couple of years, and we found that token deals are great, right? You invest in a good token, it goes 1,000x, you feel like a billionaire, you know, before it vests. But by the time it vests, usually it's a different story. But the real value that we've had and the most success that we've had is investing in stuff that we know about, right? So those two segments tend to be trading infrastructure and data. So I think these are the two pieces that you know, as the market matures and becomes a real proper trading market, right? You know, trading infrastructure, settlement infrastructure, and data. I think there's a lot of value in picking up some of these pieces, right? Not only is it a good investment opportunity, you know, we work together to make sure that, you know, we sort of build up you know, how these things interact and get a proper market going in terms of across all the segments. So that's something that we are focusing on as well.
Yeah, thanks for sharing. And we couldn't agree with you more on the building the infrastructure piece and trying to make it easier for institutions. It's something that we look at every day as well. So thank you for sharing, both of you. As we move into the last sort of few minutes that we have, I have just a couple more questions. But yeah, I mean, look, what do you think that this default contagion that's happening among the crypto lenders, do you think it's over? Have we seen the end of it? Are we going to witness a few more collapses of exchanges and firms? I'm curious to know your thoughts. I'll start with you, Philip.
You know, I think there's still a possibility, and we're still seeing some of that even this week. You know, we saw a few exchanges potentially having some issues. But really, you know, it's nothing really to panic about. I think at the end of the day, the big shock that we had first starting out with the Terra collapse in May, and then the 3 Arrow triggered credit event in June. It's only been a month since June, so do I think it's over? No way.
Doesn't feel like a month though.
Yeah. Do I think that the worst is behind us? Yes. What we experienced is pretty significant, you know, and I think in the medium to longer term horizon, it's good to have this kind of a cleanup that's going to go through the market. In the short term, we're also being very careful. You know, when you look at collateralization requirements, when you look at limit extensions and all these things. So I think the market is reacting, and that forces even the weaker hand out. And then we have a cleanup. Now, what I'm more worried about is on the macro side, because this is just crypto only. You know, we're just looking at idiosyncratic factors. And when you look at the global, you know, globally, we just had ECB and a rate hike. Now, you know, the Fed is expected to hike even further. So, do I think that the crypto winter is going to be over once credit contagion risk is down? No, I think this is going to be extended. But this is just my view. My personal opinion, I was asked this, you know, how long do I think crypto winter can last? I think it's going to be around summer of next year at the longest. Come 2024, you have Bitcoin halving again in March. You have US election year. You already have the yield curve pricing in a rate cut in the United States come 2023, 2024. All of these things coming together. I really think if you think about the market turning around late 2023, 2024, you got to start thinking about the investment horizon, right? When do you go in? Coming in at the beginning of 2024 is a bit too late. So I really think you have to start looking for opportunities Q4 this year, Q1 next year. And that's probably the right play here, right? Don't get too distracted with the small credit contagion and headlines coming out. Plan for the medium and longer term horizon is the way I see it.
Thanks for sharing. Darius, over to you.
Yeah, quick one. Just, you know, just putting into perspective, in the span of a month, market cap of crypto has gone from above $3 trillion to less than 1 trillion. That's very, very significant, right? So a lot of the defaults happened, a lot of the value got wiped out. I personally think about 90% or so is done. My lingering concerns are a few big borrowing lending guys that have still not settled their defaults, Babel being one of them. And then, you know, there's a contingent around that. You know, I think there's 2 guys who are holding on to the risk there that could be washed out. You know, I think it's probably, but it's no longer that big, right? Most of the leverage has been wiped out. So Babel is one. I think a lot of the miners have been in pain as well. So globally the miners, they leveraged up to invest in infrastructure. I think they will they have been asking for help. So I think there's a bit of a risk there too. But I think 90%, 95% done. So we are at prices at levels where macro is starting to dominate. So the recent move in the last 10 days, that was macro driven, and the market was short covering. So we have seen a stability and a base in the market. So I think from here I don't expect any shocks. So it's very similar to what Phil has said. We expect the markets to behave in a more calm manner, and we're all in rebuild mode and sort of trying to pick up the pieces. And I think there are nice pieces to be picked up. Exactly, I agree with Phil on that.
Yeah, exactly. And just like you ended, saying that there are nice pieces to pick up, I think we're all in agreement there. For the last question before we wrap up, because I think we've only got about a minute left, but what, in terms of the positive message that we can leave to our audience, what parting thought or advice would you give to institutional firms, whether they're on the buy side or like a bank on the sell side or a broker, that are currently sitting on the sidelines and wondering, should we build into this or trade this asset class? What message would you have to say to them? I'll start with you, Darius.
No, as I pointed out that the Bank of International Settlements have allowed for 1% of reserves to be kept in Bitcoin. I think that's just the start of it, right? I think Bitcoin Ether have moved in securely into this store of value phase, right? It's no longer a speculative asset. So in that sense, as an asset class, it is undervalued because not many institutions are participating yet. It's still mostly private guys, and high net worth guys. So I think there is a big pickup that will happen, as the banks and the sovereigns start to recognize this as a legitimate asset class.
Thanks. And Phil?
Yeah, and from my side, and I guess maybe this goes into, I studied financial engineering, and I just find this kind of a new asset class to be so exciting, right? We need innovators, we need leaders. Easy to sit on the sideline and just scoff and just say, oh, this is a joke, or this is not, this is a scam or whatever. When you actually come in, we're seeing this massive transition, and really staying on the sideline is a huge risk. You really have to understand, you really have to educate yourself, because I'm personally under the belief that this is going to have blockchain technology, crypto, and the digitalization of finance is a major trend. And you have to really get involved. And there's going to be volatility because it's a new asset class. But you don't let that bother you from the medium and longer term horizon and opportunity, right? And that's the attitude that we all have to have, I think. So.
Yeah, well said, Philip. Couldn't have said it better. So I just want to say thank you to Darius and Philip and the audience for your time. We hope you found it useful. Thank you.
Thank you.
Thanks, Phil. Thanks, Samar.
Thanks, guys.